Thursday, March 5th, 2020, MONERO 64, home of alternative economics and contrarian views. So the repo market, derivatives, leverage, still pointing to a lot more trouble ahead, in my opinion. The rapidly decreasing interest rates or yields in the bond market is also part of the problem. And that's what I want to talk about today. Before I start though, I'd like to show you a new design for a t-shirt and also for a mug. I bought myself one of them, one of the t-shirts. And here it is. You can see it says a crisis of faith and confidence 2020, and I truly believe it is one. And we've got the saying by Norm Franz: gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, and debt is the money of slaves. It's on the front and the back, and you've got MONERO 64 at MONERO 64 below. I'm not wearing it because it's winter here. It's a bit cold. I will wear it in the summer or when it's warmer. There's a mug for it as well. It's in the Teespring store if you're interested. I received it yesterday. So yes, the repo market is still showing signs of trouble. And how can we ascertain that? Well, it's because of the amount of help that Wall Street needs from the Federal Reserve, specifically the New York Fed, who runs these operations. The amount of overnight funds needed by Wall Street, and by Wall Street I mean the banks, the mutual funds, the hedge funds, the broker-dealers, all the institutions that are an integral part of the financial markets that keep the credit system going. They're needing more and more help from the New York Fed. The repo market, don't forget, is a market that should be an independent market of the Federal Reserve. So what the Fed is doing now since September is bailing out Wall Street. And all it means, as I've said before, is that banking institutions, financial institutions on Wall Street don't trust each other anymore. So they're not lending to each other overnight or in terms of a term repo, which is usually more than one day. A lot of times it's a fortnightly or 2-week term. And we have seen that help increase from the New York Fed. So I'll quickly go through some data here. The New York Fed, of course, provides this data to the public. You can go to their website. I'll put a link below to the repo page. So if we go back to February 20th, there was a term repo of 2 weeks. And this one is important because today is March 5th and this term repo matures today. It will be interesting to see how they roll that over for another 2 weeks. Back then, the market submitted 32.85 billion of help from the Fed. The Fed only accepted 25 billion, of course. They're only providing 25 billion for the term repos. On the same day, there was an overnight repo. The market asked for or submitted $40.25 billion in help, and the Fed obliged, mainly because the Fed is offering up to 100 billion. So it wasn't oversubscribed like the term repo. And today will be key to see how both of these are rolled over, how much more help Wall Street is needing for the overnight and the term. So if you go forward a little bit as well, let's say February 21st, there's another overnight repo. Market only needed 26 billion. You go to February 24th, another overnight repo, 40.75 billion, a bit more. You go to another term repo on the 25th of February. The market asked for just over 40 billion. The Fed accepted 25, of course. Still oversubscribed. And then 25th of Feb, another overnight, 49.46, a bit of an increase. But then the next one on the 26th, overnight repo, it decreased to 38.44. So it's only been recently in March that the amount asked for overnight funds by the market is increased. And I'll show you. Not only overnight, but term. So on March 3rd, the market asked for 70.95 billion for a term repo, a 2-week term repo. The Fed only accepted 20 billion because they're trying to phase out this. So decrease the amount they were gonna provide from 25 to 20. I think earlier in February, also the Fed was providing up to 125 billion in the overnight. As you can see here on March 3rd, in this overnight repo, the Fed only accepted 100 billion, but the market asked for 108.6 billion. And you saw in those examples from February that the highest we ever saw was around 49 billion. And most of them were in the 20 to 30 billion range. So yesterday, again, this amount submitted or funds needed by Wall Street went up to 111.47 billion. And of course, they only offered 100 billion. So I think today will be key for us to keep an eye on this. I think it comes out at around 8:30 New York time. I'm not too sure, or maybe even 8 a.m. New York. We'll keep an eye on this. We have, of course, the overnight repo matures every day. And then you have that term repo from the 20th of February maturing today. So it will be very interesting to see again, both term and overnight, if the market needs a lot of help. Early in the video, I said that rapidly decreasing yields, how can I say, lower rates from the Fed is exacerbating this repo problem. And why is that? Well, because Wall Street operates on leverage, and lower rates and lower yields basically mean that financial institutions are earning less on their operations. So usually banks and Wall Street institutions or hedge funds, they borrow in the short term and overnight, sometimes term, and they use that cash to buy longer term maturities to try to make a return. So when yields are dropping so rapidly, it's difficult for banks to make a return. So what do they do in that situation? Well, they leverage, they use derivatives, because derivatives are instruments that provide the user with a lot of margin. So you don't have to put the whole money down. You can control $1 million worth of treasury futures with about, let's say, $50,000. So that creates a lot of instability in the system. And the lower the rates go and yields go, the more leverage these people are going to use, the less faith and confidence they're going to have in each other. And that's why I think the repo market is only going to get worse. I've made a lot of videos about the repo market. You can go back into my channel under videos and you can search, put the term repo on the search bar and look for it. I've taken a couple of videos that I think are important to what I'm talking about today. I'm going to put them up in the cards and in the description. One of them, I got quite a few views. It's called Derivatives Are at the Heart of the Repo Market Problems. So go through that. That one has got almost 10,000 views. And the other one is a live stream I made late last year. Zoltan expects more turmoil in repo market. Well, Zoltan, I forgot his surname, but he's a guy who helped the Fed in their repo operations during the '08 crisis. He now works for Credit Suisse, Swiss investment bank, too big to fail. So he's been right. He's an expert on this. So that's a live stream. You can look at some other videos I made as well. I started probably making the videos in September when the repo crisis broke out. So yeah, there are a lot of distractions out there these days. In the States, you've got the presidential election campaign, Super Tuesday, and more primaries to come. We've got, of course, the big crisis ongoing, health crisis. That's huge. So there's little been talked about of the repo market, but I think today will be another key day to look at the figures again for the overnight repo and the term repo. If we see the submission amounts increasing for both term and overnight repo, I think it could mean more and more trouble ahead for the financial markets. And that's why you need to be out of the system as much as you can, or have protection outside the system, as I've said before, with precious metals. So the markets, we saw the stock market, of course, rally strongly yesterday, over 1,000 points in the Dow. I still think we're going to see quite a bit of choppiness up and down in the markets. I think we're forming a bear flag. I wrote about that yesterday in my blog. You can go there, moneco64.net blog. I put a weekly chart of the S&P there yesterday. But if you look at the daily chart as well, the flag is forming already. I said the flag in the article in my blog that the flag could go on for maybe 4 to 6 weeks. But it could be less as well. And why do I say that? Because the drop has been so sudden and precipitous last week that the consolidation might be quicker. So the flag could be quicker. So we could be talking maybe a week or two of a consolidation. And then I could see the market drop even further and even more sharply than it did last week. So I don't think we're out of the woods. Am I trying to benefit from this? You know that I have worked in the city as a futures and options broker. Yes, I do have a small position in S&P puts, way out of the money and with a lot of time. I know how much I can lose. So if you guys haven't traded futures and options, don't try to do it. It's I really don't recommend that people get involved in these instruments unless they know what they're doing. So I'm building up a position in puts in the S&P, way out of the money. I think it will hopefully pay off. If it doesn't, I know how much I'll lose, and I don't have too much in the system, as I said before. I think you need to be comfortable with how much you've got in your brokerage or spread betting account. I don't have that much, but I have enough that if the market moves the way I think it will, I could benefit from it. So enough of that. Let's see where the markets are this morning. It's 8:45 a.m. London. Gold is up $3, 1639.60. So I think right now the key resistance is around 1650.53. The low's been 1635 and the high has been 1643. Silver, yeah, still a bit frustrating, but I think it will move eventually. We're at 1718, down about 2 cents. Range has been 1713 to 1728. So the stock market right now, the Dow futures is down 1.5% or 410 points. S&P is broken back below 3,100. It's at 3078, down 1.6%. NASDAQ 100 future is also down 1.6%. Currency market, sterling is up slightly at 128.89. The euro is unchanged, 111.35 versus the dollar. The dollar is down 0.25% versus the yen at 107.25. And the dollar is up a 1/3% versus the yuan at 694. WTI crude up 0.5% at 47.09. I saw a headline that OPEC is, or I think Saudi Arabia is pushing OPEC to cut production to raise prices. Apparently the Russians are not really too keen on it. What about the bond market? Let's finish with the bond market, which is really important because it's what drives market forces, the risk-free rate of return, as they call it. The 10-year yield right now is bang on 1%. So it's up 1.5 basis point. Yeah, we've dropped very quickly, those yields in the Treasury curve. And that's not good as well. Yes, it's good to have low interest rates in an economy. And by low interest rates, I mean more like 4 or 5%. That's the 200, 300-year historical average, and not 1 or 0. But the other thing that's bad is when interest rates drop very sharply, very quickly. That's very unstable for the markets. And with all the leverage out there, all the derivatives, don't forget there's about probably more than 1 quadrillion or 1,000 trillion of notional amount of derivatives outstanding. So that's going to create a lot of problems. And I think the problems are just starting. And let's keep an eye on the repo today. Anyway, if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. And also on my blog, MONERO64.net. I wish you all a great day. Take care. Bye.